What kind of year has 2020 been so far? If we go beyond the public health and economic headlines, what's really happening in the world of financial services? And what can we expect to see next? The emergence of the COVID-19 pandemic has meant dramatic changes to almost all of our lives. The financial sector has had to cope with some very challenging circumstances, and the work that regulators do has had to pivot quite quickly to respond. I'm Scott Martin from Deloitte Center for Regulatory Strategy, and you're listening to Regulated Radio. I'm excited to have Andrew Bulley and David Strachan back on the show today for our latest Working From Home podcast. We'll be looking back at our annual predictions for the year in financial services policy, asking how the pandemic has changed our expectations, and taking a closer look at the trends that we see enduring nonetheless. I think it's safe to say that this hasn't been the easiest year to predict from the outset, but this is our chance to see how we've done so far. This is Regulated Radio. It was probably in early March when it occurred to most of us that 2020 was not going to be the kind of year that we expected. Efforts to contain the spread of COVID-19 had failed, and it was becoming increasingly clear that most countries in the world would have to impose lockdown restrictions. Now, we have had an extraordinary 4 months since then. Besides the enormous change to our daily lives, there's also been a huge wave of rapid changes to government and regulatory policies in order to respond to the circumstances and their effect on society, the economy, and the financial system. It's something that's made those of us who work in financial services policy very, very busy. So let's talk about how. I'm very happy to introduce our first guest and a regular on the podcast, Andrew Bulley. Andrew is a partner in Deloitte Center for Regulatory Strategy, and you heard him last on the show back in January talking about our predictions for the year that was supposed to be 2020. Andrew, a lot has changed since then, hasn't it?
Yes, indeed, Scott. Yes, I think we can all agree that the world is looking rather different now from how it did just 6 months ago.
I think we can agree that. But if we look through the extraordinary experiences we've all lived in the last few months, if we look at the long-term trends that we've been forecasting for a while now, how is the broader financial services regulatory agenda doing right now?
Yeah, well, since the Regulatory Outlook 20 publication, I mean, clearly the COVID-19 pandemic has, as we all know and as we've all experienced, caused severe disruption to societies and economies across the globe, and in ways almost entirely unforeseen. And at the same time, we've seen an unprecedented level of state and regulatory intervention since the start of the crisis. But notwithstanding that intervention, the economic outlook remains highly uncertain. Now, we observe in our interim outlook that the experience of the last few months, wholly unprecedented as it has been, it represents a very profound and searching stress test of the regulatory reform agenda of the last decade. And in due course, we expect that policymakers and regulators will want to assess the success of those reforms in the light of the pandemic experience. And I think all that said, when we revisited the themes and topics discussed in our 2020 outlook, we were struck by how many of our predictions remain highly relevant, despite this changing and very uncertain environment. In many ways, the pandemic experience has lent further importance and impetus to the key regulatory themes we highlighted at the start of the year. And here I have in mind especially the themes of securing good consumer outcomes and protecting vulnerable consumers, operational and balance sheet resilience on the prudential side, and the way firms' governance and culture are responding to wider developing political and social expectations in areas such as diversity, inclusion, and fairness.
All right, thank you, Andrew. That's really interesting. I'd like to bring in our next guest, David Strachan. David will be familiar to most Regulated Radio listeners. He leads Deloitte Center for Regulatory Strategy in EMEA. David, it's good to have you back.
Thanks, Scott. It's always a pleasure to be here.
So, David, we had you on the podcast in April to talk about COVID-19 and its effect on the financial sector. And at the time, you said that you saw more differences than similarities between this crisis and the global financial crisis of 2007, 8, and 9. With the benefit of a few more months since then, is that still your view?
Yes, Scott, that remains my view for now. Since April, we've had some very important developments which point to the overall resilience of the financial system. We've had stress tests or scenario analysis of the largest US, UK and European Union banks, and all those point to their collective ability to withstand significant losses. We've also recently seen a report from the Financial Stability Board evaluating the impact of its too big to fail reforms following the last crisis. That, amongst many other things, demonstrates the materially higher levels of capital and liquidity that banks now have relative to 2007. Today, banks that are considered systemically important at either a national or a global level have risk-weighted Tier 1 capital between 12% and 16%. And that's up from the mid-single digits for some back in 2007, 2008. And if we look to liquidity, we see a broadly similar picture for the liquidity coverage ratio. But, and as you know, with me, there's almost always a but, we have to remember that we're still at the very early stages of understanding the full impact of the extraordinary lockdown of the global economy. We'll see more information when the banks report their second quarter results later in July or early August, and then impairments will be really carefully scrutinised. And we should also bear in mind that in some countries, including our own, the full economic impact of COVID-19, particularly on employment, is being cushioned by furlough schemes, government guaranteed loans, and the like. So in short, we don't yet know the full impact on banks' balance sheets, and it may be some time before we do. So in the meantime, I expect supervisors to remain vigilant and cautious.
Indeed, and certainly a lot to watch there. But David, one of the things that we've said in our 2020 halfway report is that despite everything going on, financial regulators have made it clear that it's full steam ahead on priority regulatory topics. What is it that led us to conclude this now?
Well, I think it's fair to say, although there have been some notable delays announced due to COVID-19, particularly I'd point to the 1-year delay to Basel's 3 implementation deadlines. Most of the regulatory priorities that we highlighted in the regulatory outlook for 2020 remain highly relevant. And firms, in my view, can't really afford to lose momentum on their major regulatory change programs. I'll pick out a couple of major areas where regulatory initiatives are still going ahead at full steam. One of those is IBOR transition, where the final deadline of end 2021 hasn't been moved. Another is sustainability, where we've seen a very large number of new publications on regulatory expectations in the last few days and weeks. One that I'd single out is the ECB's, the European Central Bank's recent consultation on its guide on climate and environmental risks. Now, that contains a number of extremely demanding expectations, and the ECB currently envisages that the guide will take effect at the end of this year. And in that case, there's a huge amount for Euro area banks to do between now and then.
Now, Andrew, I wanted to shift a bit from only looking at regulatory policymaking to asking about the work of financial supervisors. Now, as a former financial supervisor yourself, what do you think is going to be at the top of their agenda for the rest of this year?
Well, it's going to be a very busy agenda, very challenging agenda, clearly, for both supervisors and firms. I think the immediate supervisory response to the pandemic showed that the lessons of the financial crisis have been very well learned. Measures that took months to roll out in the last crisis have been implemented with, I think, very impressive resolve and speed. And I think at a time of difficulty such as this, that the supervisors will be extremely focused on outcomes. And their response to this time has been entirely consistent with that strong outcome focus. So I think a number of key outcomes clearly underlie the measures they've so far taken. And those outcomes include ensuring the continued flow of credit and investment into the economy, avoiding pro-cyclicality, ensuring firms deliver fair treatment of consumers, especially those left vulnerable by the pandemic, freeing up both firm and supervisory resources through deprioritizing non-essential supervisory activity. And I think a lot of decisive work has been done in that area. And I suppose attending finally to what we might call the plumbing of the financial sector, the payment system, the clearing and settlement system, and the preservation of orderly markets. Now, I think all of those outcomes will remain central to the supervisory priorities and agenda over the next few months. But given what has been achieved to date and recognizing the unparalleled degree of economic uncertainty currently, as David has mentioned, We think the focus will shift on to ensuring that individual firms and the financial sector generally remain financially resilient in relation to the key supervisory objectives of financial stability and consumer protection. And that will, I think, lead to a very sharp focus on individual firms' resilience, as shown by whatever stress testing has been applied to date. And it also suggests that the priorities for supervisors in the near term will range across, say, liquidity management in the asset management sector, which is already a key focus area for supervisors before the crisis. And in the banking sector, provisioning for expected credit losses under IFRS 9. And in the insurance sector, the effects of bond market trends and claim experience.
All right. Now, David, we said when you were on the show back in April that the COVID-19 pandemic has been, at least at the beginning, a major operational resilience challenge for the financial sector. How would you say the sector has fared with that challenge? And will regulators take any lessons from this in their ongoing resilience work?
Without a doubt, COVID-19 has been a very significant test of the financial sector's operational resilience. I think it's only right and fair to recognise that the sector's performance has been very high in that test. Clearly, not everything has been perfect, but overall, most firms have been able to adapt their operations to the circumstances in a way that either the services they offer to their customers have largely continued, and or the financial system has continued to operate smoothly. The fact that the move to remote working had to happen more or less overnight makes that achievement even more remarkable in my view. But of course, this is obviously, as we see around us, an evolving situation, and there are still potentially some operational challenges ahead. We've said before that we think firms should prepare for lockdown restrictions to ease on and off for some time as the threat from the virus changes and adapts. And we know that supervisors are keen to see that firms are constantly updating their business resilience plans in the light of the most up-to-date information. They shouldn't simply be using the same plan they hastily put together in March, but rather should be refining and improving those plans more or less continuously. Now, you asked about lessons learned. Indeed, I think there are a few things that supervisors are going to take away from this. I'll give you a few examples. So the first is that there's a very broad range of scenarios that can threaten the resilience of the sector. COVID-19 has shown us that threats can come from much more unexpected places than just cyber and IT risk. Second, the focus really should be on the resilience of business services. And finally, I'd say that COVID-19 has been yet another reminder that black swan type operational events need to be taken very seriously. Firms should rightly plan for individual or idiosyncratic threats to their operations, but firms and regulators also need to prepare for how they will respond to plausible events that might threaten the stability of the entire financial system. And as I said at the start, the system responded very well to the immediate threat, but it's essential that we don't rest on our laurels and that we do ask ourselves, what could be next? Could it be worse? And most importantly, are we ready for it?
Now, Andrew, a question for you. One of our main 2020 outlook predictions was that regulators would start to look much more closely at whether financial services customers are getting good outcomes from their interactions with firms. How would you say all the challenges around dealing with the pandemic have changed this?
Yeah, it's a good question. I mean, I think an overarching point is that the pandemic created vast swathes of consumer vulnerability almost overnight. And in many cases for consumers who hitherto would not have been considered vulnerable and indeed would not have considered themselves vulnerable. And I think in response to that, many jurisdictions across the region have gone to really great lengths to implement measures to provide relief for customers experiencing financial hardship. And that's not only an issue for retail consumers. Many businesses, particularly smaller businesses, have inevitably been seriously affected by the lockdown process and have found that their business interruption policies have not provided the cover they expected. In the UK, that's led the UK's FCA, the Financial Conduct Authority, to initiate a series of test cases on insurance policies, where it will seek to represent policyholder interests and achieve a court determination on the meaning and scope of some key policy clauses at issue. Overall, I mean, we think that this intense regulatory focus on achieving good customer outcomes will remain, especially as temporary government and regulatory relief measures to help customers come to an end. But we also see a clear and heightened regulatory interest in what the FCA has referred to as a purposeful culture. That is how firms' governance and cultures are responding not only to the immediate social and economic challenges created by the pandemic, but also to society's rapidly developing expectations in areas such as fairness, diversity, and inclusion.
So, Andrew, if we zoom out to all of the regulatory challenges that we're talking about today, there's clearly a lot of things that firms need to consider as they think about the rest of this year. And as we've been saying, there's a lot of uncertainty on top of that about the next 6 months. But what do you think firms should be doing right now in order to be best placed to manage the regulatory pressures from here on?
Well, clearly the rest of 2020 is going to remain challenging, both for firms and supervisors. I think that's just putting it mildly. But from a firm perspective, I would see 4 overriding areas of focus. Firstly, their financial resilience under various plausible adverse scenarios, including their contingency planning. That is, identifying now what management actions they could take if the need were to arise. I think secondly, supporting their customers as much as possible, especially again those who are vulnerable, and ensuring that their governance, their MI, their systems remain tightly tailored to that end. Thirdly, I think operational resilience, including honing their risk and control frameworks, especially given the new normal of increased remote working and the risk of unanticipated operational and control threats. And finally, we're living in a world of unexpected developments and consequences. I think firms need to stand ready to respond quickly to ad hoc supervisory requests and information gathering exercises. Now, these may come across as a chore, but they are essential to assist the supervisors frame and optimize their continuing response to the pandemic, and that's in all our interests.
Now, Andrew, David, as regulated radio veterans, you'll both know that we always end the show by asking for predictions about the months and years ahead. And in this case, since we're talking about the year 2020, I'll ask about the next 6 months. What I'd like to know is, what do you think by the end of this year will have proved to be the biggest regulatory challenge for financial services firms in that time? Andrew, what do you think?
Well, there are some very grim and sobering economic forecasts around at the moment, and I think politicians and central bankers across the globe have been very frank about the risks of a recession on a scale we have not experienced, at least since the Second World War. And against that background, I think for firms it's going to be the twin challenge of managing their balance sheets in the face of potentially unprecedented economic uncertainties and challenges, but doing so importantly in a way that is supportive of an economy under severe stress, and also in a way that does not lead to unfair customer treatment or to poor consumer outcomes. And finally, let's just not forget that this focus on customer outcomes does lead unavoidably to the operational resilience issue, an issue we discuss and highlight at some length in the interim outlook. Because serious operational disruption almost always goes hand in hand with consumer disruption and uncertainty, as well as serious brand and reputational damage.
All right, and David, how about you?
So, Scott, my candidate for the biggest challenge, at least for those financial services firms which use the UK as a base from which to access EU markets, is the end of the Brexit transition period. That's going to happen at the end of December this year. Now, it's just over 4 years that have passed since the referendum, and we've now less than 6 months to go before the end of the transition period. Yet many of the cliff edge risks that we've been discussing over those years, they all remain. Clearly, it's possible that many of these cliff edge risks will be dealt with by positive equivalence decisions by the UK and EU authorities. The key issue here concerns UK CCPs and whether the EU finds that the UK regulatory framework is equivalent and then recognises those CCPs. And certainly based on past experience, there are grounds for cautious optimism here. But there could also be significant challenges with UK firms carrying out life cycle events in respect of unclear derivatives transactions with EU counterparties. On the face of it, you'd say positive equivalence assessments and decisions by both the EU and the UK shouldn't be a problem, given that their respective regulatory frameworks are currently pretty much identical. But there is clear evidence in recent days that these assessments have become bound up in the political process and the political negotiations, certainly as far as the EU is concerned. So in sum, all this creates significant uncertainty for what happens over the remainder of this year. And therein, I think, lies the big challenge for industry.
Uncertainty definitely seems to be a theme for the rest of 2020, but I think the two of you have done a good job at clarifying it for us. Andrew, David, thanks so much for coming on the show.
Thank you for the invitation, Scott.
Yeah, likewise. Thanks, Scott.
And there it is, only 6 months into the year, and there's so much going on. It's hard to imagine the second half of 2020 will be more eventful than the first, but it might, at least, be just as interesting. Now, I'm glad you've made Regulated Radio part of your summer repertoire of podcast listening. We're still going strong here, lockdown or no lockdown. But if you have thoughts for the next show in our Working From Home series, please give us a shout at regulatedраdio@deloitte.co.uk. We'd absolutely love to hear from you. And remember, if you like the show, hit the subscribe button to ensure you receive notifications about our next episodes. And if you're already subscribed, you can give us a review on your podcast platform of choice. But that's all for now. Thanks so much for joining us, and you'll hear from us again soon.